Right now, on the same day, the Dow Jones hit an all-time record high, crossing 52,900, and the Nasdaq got smacked around like it owed somebody money. That's the market doing something it hasn't really done since 2024, rotating. Big money is quietly walking out of the same 5 or 6 tech stocks that carried this whole bull market and into industries most people ignore: industrials, banks, small caps, power companies. If you didn't get that memo, your portfolio might be riskier than you think. Today, what this divergence looks like, the real catalyst behind it, 2 forces, not 1, and the simple math to check whether your own 401k is secretly betting your future on about 5 companies. This one's for anybody with money in the market, whether that's $1,200 in a Robinhood account or your whole retirement in a target date fund. If you're new here, I'm Sum, this is Sum Knots. If that's useful, hitting subscribe genuinely helps me keep doing this for a living. Let's get into it.
The headline number. This past Thursday, the Dow shot up nearly 595 points, about 1.14%, to close at a record 52,900.07. Same day, the Nasdaq dropped over 207 points, about 0.8%, and chip stocks got hit even harder. Lam Research and KLA down double digits for the week, Micron and Applied Materials down, even Nvidia dipped. The S&P 500 basically shrugged and closed flat. Here's the part that trips people up. How can the market be up and down on the same day? Because there isn't one market. There are 3 different scoreboards, built differently. The Nasdaq and S&P 500 are cap-weighted. Bigger company, bigger pull on the index. The Dow is old school, price-weighted, meaning it only cares about a stock's dollar price, not the company's actual size. So when Apple jumped almost 5% that day, even though it's only about 3.5% of the Dow, it drove something like 15% of the whole index's gain, just because its share price is so high. That's why a record high can really be carried by a handful of stocks moving opposite to tech, and why the Dow and Nasdaq can tell you 2 totally different stories in the same afternoon.
Why is this happening? 2 forces stacking together. Force 1. The June jobs report came in weak. The U.S. added only around 57,000 jobs, well under the 110,000 to 115,000 expected, and unemployment ticked up to 4.2%. Normally, that spooks a market, but investors read it as the Fed is less likely to hike rates, and lower rate expectations are rocket fuel for stuff that's been sitting in the corner for 2 years: banks, industrials, small caps, since they carry more debt and benefit way more from cheaper borrowing than a cash-rich tech giant does. Force 2, the one that connects to AI, investors aren't betting against it, they're betting on its second wave. Think gold rush. In 1849, most prospectors went broke. The people who made money sold shovels, pickaxes, and blue jeans. AI is doing the same thing. Hyperscalers like Microsoft, Amazon, Meta, and Google are on pace to spend around $700 billion combined on AI infrastructure this year. And that money doesn't just buy chips, it buys electricity, cooling, concrete, and steel. Constellation Energy signed a 20-year deal with Microsoft just to restart a nuclear reactor with 3 Mile Island purely to feed data centers. Companies like Vertiv, which builds cooling systems, or Sterling Infrastructure and Comfort Systems, which pour concrete and run HVAC for these sites, those are today's shovel sellers. That money mostly lives in industrials, materials, utilities, and small caps, exactly the corners driving the Dow right now, and a big reason the Russell 2000 has kept pace with or beaten the Nasdaq for chunks of this year. This is where most retail investors get caught off guard. A lot of people think, I own an S&P 500 fund, 500 companies, I'm diversified, I'm fine. You're probably less diversified than you think. The so-called Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, make up roughly a third of the entire S&P 500's value. Not a third of the companies, a third of the money. Nvidia alone is about 22% of their combined weight. Add JP Morgan and Berkshire Hathaway, and the top 10 stocks make up close to 40% of the whole index. Let's make it personal. $10,000 in a plain S&P 500 fund, roughly a third of it,
$3,000 to $3,500 is riding on basically 7 companies. That's like hitting an all-you-can-eat buffet for the variety and finding out a third of your plate is broccoli, whether you ordered it or not. Some of you love broccoli, fine, but you should know it's there. Before anybody dumps every tech stock they own, that's not what I'm saying. These are genuinely some of the best-run, most profitable companies on the planet. You don't have to be a Wall Street legend to know a great business can still hurt your net worth if it's too big a slice of it. This isn't about abandoning tech. It's about knowing your real exposure, so a rotation like this doesn't catch you off guard.
3 steps, none of which require becoming a day trader. Step 1. Awareness. Look at your account and figure out what percentage sits in mega cap tech versus everything else. Can't fix what you haven't measured. True of your budget, true of your portfolio. Step 2. The 5% drift rule, a version of what a lot of advisors genuinely use. If any stock or sector drifts more than 5 percentage points above your original target, you set out for 25% in tech and it's quietly crept to 32% just because tech ran up, that's your signal to trim back to target. Not because it's about to crash, but because your risk changed shape without you deciding that on purpose. Step 3. Where the trimmed money goes. Keep it simple, an equal weight S&P 500 fund, like the Invesco Equal Weight ETF, ticker RSP, holds all 500 companies at roughly the same size, instead of letting the giants dominate, which instantly cuts concentration risk. Want direct exposure to this rotation? Industrials, financials, and small caps through something tracking the Russell 2000. I've got a whole video on building a simple 3-fund portfolio. Links below. Quick disclaimer, because I'd be a bad ex-advisor to skip it, I'm not your financial advisor, this isn't personalized advice, and past performance never guarantees future results. Figure out what's right for your own situation, ideally with real professional input. Here's the takeaway. The market didn't get scared this week, it got smarter and it spread out. Your job isn't to correctly call every rotation before it happens, because almost nobody does that consistently, including people paid a lot to try. Your job is a portfolio diversified enough that no single rotation, tech out of favor, industrial suddenly in style, can wreck your whole plan. Know what you own, know how much of it you actually own, and let a boring, automated, diversified plan do the heavy lifting. If this helped you make sense of your money this week, hit subscribe, it genuinely helps the channel. And I'll see you in the next one. Peace.